of DC. She's the one waving. We've worked together to bring you today's deep dive on the Union Budget 2021-22. We're thrilled today to be joined by two deeply experienced practitioners in the fields of law, policy, and taxation. That's Suhail Nathani, who is the managing partner of economic law practices, and N. Madan, who is the Southern Regional Tax Partner at PwC. Both these gentlemen are very recognized in their field, have over close to 3 decades of experience doing what they do. So we really are getting the benefit of both deep knowledge and experience and judgment that comes with the combination of those two characteristics today. So gentlemen, thank you so much for joining us. Without further ado, I'm going to turn this over to Suhail to start us off. But with just before I do, I want to make one point clear. This is now the second day of the after Finance Minister's speech. And the goal of today's webinar is to not tell you what was in the budget. We had a readout yesterday that was sort of focused on that, but to give you more context, to provide analysis, to help you with actionable intelligence as you figure out where do you go from here in terms of growing your business in India and what to expect sectorally in terms of the impact of the prescriptions announced yesterday. Suhail, please take us away.
Thank you, Alex, and thank you everyone for joining us this morning, your time. We had a quick roundup this morning, and we decided that I would go first talking about some of the policy matters coming out of this budget, and then I would hand over to Madan, who would take us through the taxing sections. And I don't mean that as a pun, but it is indeed going to be the taxing sections that he takes us through. The interesting part of this budget is that, contrary to everybody's expectations, there was an expectation of huge increase, if you will, in taxes because the government had lost a lot of revenue in the COVID period, and India had the most drastic lockdown, more than most countries, and the economy really ground to a halt. So it was very important that this budget actually built confidence back in the industry in India. And I'm pleased to report that, in my view, this has been done in a big way. The biggest takeaway from this budget today is that there is no increase in taxes. And that is huge. For those of you who have been following India over several years, we always tinker with the tax rates. There's always increasing, chopping, changing. In this budget, especially given the background, we had no new levies, no clawbacks for COVID-related revenue loss. The market was so pleased that there was a huge, what I like to refer to as a relief rally in the stock market. Couple this with some of the important policy announcements made by the government, I think we have a very buoyant economy here, and we have a very charged up industry and consumer, because it's the consumers who will drive this market eventually. If there was one thing that you would ask me to highlight in this budget, that is the huge mindset that the government has brought to the table. And that is that the government is not looking to mince words and say that we are disinvesting and whatever else. They have clearly used the word privatization. They are going to get out of every aspect of business, at least that's a clear statement of intent, and they will maintain a bare minimum presence in the strategic sectors. These including atomic energy, space and defense, transport and telecom, power, petroleum, coal and other minerals, banking, insurance and other financial services. And even though they refer to these as strategic sectors, they have announced two things. One, that they will allow FDI in insurance to 74%, and they will privatize, or they will list essentially what is the crown jewel of insurance companies in India, which is the Life Insurance Corporation. So if you see how India has worked over the years, honestly, the government uses these vehicles to interfere or to intervene in various aspects of the market. So the Life Insurance Corporation, with its monopolies, had large amounts of reserves, which was then being used, misused, applied by the government to interfere in sectors where they needed to. So in case there was a failing bank, in case there was something else, the LIC would come in and bring in money. So to actually say that they are privatizing LIC is a big thing. I also want to share with you my personal experience. I sit on the board of the oldest listed mutual fund in India, and there was a situation where a lot of the public sector banks had taken positions, and there was an American fund house also who had the single largest presence within that fund house, and this is the Unit Trust of India, or UTI. Last year, the government actually got all the public sector banks to sell their shares, and they listed the company and have effectively let T. Rowe Price take the lead now in developing this mutual fund. And I think that's a clear indication of a change from the governments of the past, where policy was one and implementation was another. This government has both the ability and the direction to carry through their promises. Some of the sectors, defense, we have for the longest time flirted with defense to say that there will be privatization and whatever else. We have quite an active practice in the space, and we are noticing that the government is actually going out and are not procuring large scale, but they are procuring need-based products, and the trend is shifted to going directly to governments and talk and procuring. And perhaps this was driven in the last year by the situation we have on our borders, but clearly government has taken a lot of good direction over there for private investment as well. Energy, big play here on energy, solar, non-polluting, non-fossil fuel, renewables. So nothing big on nuclear, but government talks about a hydrogen fuel mission, which is a big opportunity for global players here.
Amazon में 130 employees थे, 30 permanent.
I'm sorry. Could everyone please mute their microphones? Apologies, Suhail. Please go ahead.
So we need to mute everybody else. Is that better?
Yeah, I think that's done now. Suhail, please go ahead. Sorry about that.
So infrastructure, that is the single largest object really needs to push right now. And honestly, this budget is big on infrastructure. There is a lot of details, opportunity, meat, if you will, in the budget on infrastructure, a lot of debt, a lot of monetization of insurance, of course. As I told you, 74% FDI cap. We'll talk about how it is going to be implemented. Big focus on logistics, highways, significant changes. Healthcare is a big beneficiary, not surprising. Healthcare, India has neglected it for decades. We now see a 137% increase in healthcare spend. Healthcare, 137% includes the outlay for the COVID vaccines. It also includes amounts for water and sanitation, and of course, the direct build out of hospitals. The government has also been very prudent on this kind of stuff. So they know that a lot of hospitals in India are run by charitable organizations. So for the smaller charitable organizations, they've created a regulatory regime which will actually help them establish and operate healthcare centers and hospitals in India. I know this does not directly attract FDI, but equipment sales, the quality of health, all these things will have a huge impact on the economy. And of course, the infrastructure process over here being the big story, because India definitely needs large infra spending, and that's something that the government is pushing it along. What is the overall sentiment? India is open for business and the government will facilitate investments. We have had the pleasure of working with the Invest India body for the last few months, and we have actually experienced a different mindset, because when we go to talk to them about issues being faced by our clients, they're actually very proactive and they work to resolve some of the issues. They get it clarified, and some very ticklish issues which for years have been pending. So all in all, we believe over here. Sectoral analysis, defense and aviation. While the budget has marginally increased, and quite honestly, we're happy for that, because we'd much rather see investments everywhere else but large-scale money going to defense. However, the allocation is marginally, effectively about 0.9% higher in terms of actual cash that is going to find itself into the defense space. The strategic disinvestment is a big one, because the government has actually said that they will get out of everything except the non-strategic positions, so and leave it to private sector. So defense is going to see some privatization in the coming financial year. Customs duties, which are very important, because the government of India has a big Make in India process, and now what the government has actually done is they are looking at using this Make in India by rationalizing customs duties. So, for example, the aircraft parts is something that they have reduced duties on. A lot of strategic inputs into the defense sector, which is not made in India, will now be imported into India. Oil and gas, independent gas transport operator is being set up to facilitate and coordinate booking of common carrier capacity in all natural gas pipelines. Asset monetization, which is a big thing. They will actually take India's largest petroleum companies and bring increasing private participation in this. There are new gas line projects being planned in the Union Territory of Jammu and Kashmir. There are several states which are seeing large-scale investments, and Jammu and Kashmir is one of them. Renewable energy, I touched upon, hydrogen energy mission, and of course, the solar energy is receiving a lot of attention, including one of the few sectors which has seen a increase in the customs duty for the parts. So India wants to become self-reliant in this. We had represented the government of India in a dispute at the WTO on solar against the US. I believe now most of that is done, because a lot of investments have come into India, and we have seen the consumption of this increase in a big way. These are the main highlights. This is a national monetization pipeline which is being brought about, where brownfield assets in roads, railways, transmission, oil and gas, airports and sports facilities will be opened up. There's foreign participation in InvITs and REITs. Some debt funds are to be allowed to raise zero coupon bonds. There will be removals of restrictions on tax exemption issues, so that money is easily raised for infrastructure. And of course, the big creation of bad banks is a banner one, because India is plagued with bad debts in the infrastructure sector, and sadly, the IBC was paused during the COVID, and these bad loans have continued to plague the system. What is the big realization over here is that whenever a new infrastructure project is opened in India, demand is never a problem. You open a metro in a city, it hits capacity almost on day one because there's so much of pent-up demand, there's so much of lack of infrastructure that monetizing these assets should not be difficult for the government of India, which will, of course, boost in turn the economy and start the flow of capital back into other businesses. Logistics, again, another issue. There is the National Highway Authority of India, which is actually building out 1,300 kilometers, I believe, of highway every day in the country. So they are going to get a lot more money. There's going to be dispute resolution processes that are being streamlined. We are working with the government on one of the issues on land acquisition because that's a big problem. So the National Highway Authority of India acquires a lot of land and there are some hiccups, but the government has realized it, proactively working on resolving these issues. Airports are up for sale. We just had privatization of 6 airports in the last fiscal year, and tier 2 and tier 3 cities also will see new airports and privatization coming up. The government had launched during the last year a program for low-cost flights into tier 2 cities, and this increases the number of aircrafts that are in play in India. And realizing that, and this is just an example of how the government is working in tandem with the entire policy. So India has an international financial services center that is sitting out of Gujarat, and they have amended the laws there to encourage the funding of aircrafts from that center. So a lot of aircrafts in India are funded through Ireland today, but they want to move that business. So a lot of tax exemptions, a lot of relaxation and compliances are being given for the funding of aircrafts from the IFSC in India. Some of the problems were the procurement of aircraft. So when airlines did not pay the money or went belly up, enforcing awards that you got outside of India to attach aircrafts was proving to be a challenge. They are now integrating the litigation system in the IFSC. So to that extent, enforcement of these awards should be far more efficient. They're looking at bus transport in a big way, which of course will impact the automobile sector. And I wanted to highlight at this point that the automobile sector has a situation where they have come out with a scrapping policy. So commercial vehicles, 15 years, non-commercial vehicle, 20 years. Today, it is a voluntary policy, but seeing how the government functions, something is issued voluntarily and pretty soon it becomes compulsory. They've also disincentivized the use of old vehicles by increasing the tax payable on the old vehicles that operate in the country over a particular age. So a combination of these efforts will actually see an increase in sales of automobiles, and that's something that the market has already factored in yesterday. Insurance, of course, was till now a sensitive sector. Sensitive for 2 reasons. A, it's insurance, and B, it was really the deep pockets of the government that allowed them to do a lot of interventions through the insurance companies and life insurance in particular. Of course, we have had private insurance in India for a while, up to 49%, but clearly it has not attracted the kind of investment that it ought to attract. So this has been modified. We are aware that previously the policy announcement and its implementation, there was a huge lag. We have mapped what the government really needs to do. There needs to be an amendment to the Insurance Act, which requires a passage through Parliament. Previously, the government was unable to carry through the bill in both the houses for increase of this threshold. Today, the government is in control through its allies and its own strength in Parliament to carry this bill through much quicker. So we are very optimistic that there will be no delay. The other regulations that need to be amended do not require a change in Act, so they can be done through regulations which the government is fully in control of. Again, while 74% has been allowed, there are some riders. Majority of directors on the board, key management personnel would have to be resident in India. They have actually done this before in telecom. So it's just that model that they're following. At least 50% of the directors have to be independent directors. This is not a big deal because today, even Indian companies where the chairman of the company is a executive member of the board and is involved in the operations of the company has to have 50% independent directors. So this is something that can be complied with fairly easily in the Indian context. And of course, there is this small detail which can prove to be the devil, but a specified percentage of profits may also be required to be retained as general reserve, but that I believe is part of a regulatory structure. They do it for banks, they will do it for insurance. Life sciences, another opportunity for foreign companies coming into India. Of course, the big story here is the increase in spend by the government of India. So there will be various opportunities for life sciences in India. There are other policies which will tie in with the increased budgetary spend and create an opportunity. And finally, I just want to touch upon this larger theme on ease of doing business. And that has been a huge bugbear for many people looking to do business in India. This long tail of tax litigation. Government is trying to settle several of these. They're trying to create ability to consult with the government and bring about certainty, whether it's in transfer pricing, whether it's in underlying asset transfer. That's something, of course, Madan is going to speak on. There are lesser compliances that are being brought about because they're relying on e-governance in a big way. The National Bad Bank will provide two opportunities. A, it will strengthen lending in India, and B, it will provide another opportunity for capital to flow into assets which require to be restructured, and that will be a central focal point. This is also something that we have been advocating long in India, which is decriminalizing sections under the Companies Act. They did that in the last financial year, and now they're going to do that for limited liability partnerships, which of course increases the confidence to invest. There will be exemptions from multiple filings, including in the GST space. Easing of debt coming in a big way is, of course, something that will provide the lubrication, if you will, to the economy to make the investments. And finally, the International Financial Services Center is now becoming important, and that will enable you to come into India and sit effectively in India, but not be subject to the larger regulatory regime and do business in India. So I'm going to end here and hand it over to Madan, and then, of course, post that open for questions. Thank you very much.
Thanks so much, Suhail. Really appreciate it. That's quite helpful to see the myriad announcements organized by sector to get a better thematic sense of who's going to be affected and how, and what that might do to shape the outlook for that sector in 2021 and going forward. So thank you so much. I forgot to mention this, folks, before we go to Madan, we will have some Q&A. So there will be opportunities to ask about the presentations and any specific questions that you or your colleagues are facing after the budget with some of the announcements that you've heard. You can post the questions in the chat box, which is accessible with the little sort of cartoon box icon at the top of your screen, or by sending an email to my colleague Nalima, who will then post the question in the chat box, or we'll give you an opportunity to ask your question live once we turn it over for the Q&A. Madan, please take it away.
Sure. Thanks, Alex. I hope my screen is visible right now.
Madan, yeah, you can just, there it is.
Okay, fine. So thanks a lot, Alex and Nilima, for the opportunity. And dear friends, good morning to all of you. Just taking it forward from where Suhail had left in terms of easing some of the burdens of the taxpayers. One important thing that the government has done is, you all might be aware that the government had introduced what we call it as the Vivad Se Vishwas, basically don't litigate and just trust. So this is a scheme whereby the companies which were having a lot of litigations could approach the tax department and pay a one-time tax on the disputed amount without paying any interest and penalty. This was available till 31st of January. In fact, it was supposed to be only till 31st of March 2020, but because of the pandemic, it got extended. And now the date has been extended further by one more month because the government is really looking at this as an opportunity to resolve good amount of disputes, and they are also seeing a good response to that. Moving on to the presentation. The first one is on the corporate tax rates. I must tell you that there is no change with respect to the corporate tax rates. Just to recap, the portions that have been highlighted in bold under the not claiming prescribed deductions, the government introduced last year that if there are companies where the companies do not want to claim any tax exemptions, in such a case, then they lowered the corporate tax rate or the headline tax rate to 22%, and with surcharge and cess, it was pegged at 25.17%. And in case of companies which are incorporated or which are set up after October 2019, it was even brought down to a much lower percentage of 15%, and with the surcharge and education cess, it translated to 17.16%. So these rates are quite competitive as per the government with as compared to the rest of the world, and therefore the rates have not gone for any change. No doubt, when we look at these rates compared to the companies, even domestic companies, which are still claiming a lot of tax exemptions, if you look at the other domestic companies tab, it is still at 33.38% when I'm just looking at the comparable in terms of the turnover. And in case of foreign companies, it could be as high as 43.68%, and LLPs and firms about 34.94%. Therefore, the sort of difference between companies which are opting to go under the new regime, as we call it, and companies which stay back in the old regime is quite substantial, and the government has not changed these rates in the budget. This is about the key sector announcements. I don't want to spend time on this, considering Sohail has clearly explained the kind of budgetary allocations to each and every sector. And I've also put in some of the tax proposals which have been identified to the specific sectors actually. And obviously I would dealt with these as we go along to the subsequent slides. Just to give a heads up, therefore, in terms of most of the amendments in tax laws, I would say they are sector agnostic. There has not been very huge amendments that have been made with respect to a specific sector, and the exceptions could be like what we heard from Sohail earlier, the thrust that has been given to the International Financial Services Center, which we will talk about it in a bit. Digital tax or the equalization levy. Just as a snapshot, the government introduced in 2016, in line with the BIPS initiative, they introduced equalization levy, which is outside the framework of income tax laws. So it is part of the Finance Act and not part of the Income Tax Act. It was levied only on online advertisements and related payments at the rate of 6%. But in 2020 Finance Act, which was the last budget, not this one, which was the last budget, the equalization levy was expanded to include a 2% levy on consideration received by a non-resident e-com operator from e-com supply or e-com services to specified payers with effect from April 2020. So who is the e-com operator, or who's what is the e-com supply or services? This will have a lot of implications to any company which is set up abroad, which has got subsidiaries or associates in India. So any kind of supplies that are made by using the ERP platform, which is either owned or managed or controlled by the foreign company, then such supplies or such services would cover under the ambit of equalization levy. Good amount of representations were made in terms of restricting this equalization levy ambit only to cases where online transactions or online advertisements are being made, and the marketplace has been done, and it is not to include companies which are having transactions with their related parties, etc. That was the industry expectation. And the industry also expected that even if the equalization levy were to be applicable, then there should be a foreign tax credit in the home country. However, in the budget proposals that were announced yesterday, contrary to the expectations from the industry, there were no major clarification on what kind of supply or services would be under the ambit of equalization levy. That was not touched at all. The only reprieve that was given was with respect to fees for technical services or royalty. If it is covered as per the Income Tax Act, then such amount will not be covered from the perspective of equalization levy. For example, if India is making a payment toward technical services to a US company, or if it is paying a royalty, and this royalty or fees for technical services is covered as such under the definition of royalty or fees for technical services as per the Indian Income Tax Act, read with the India-US Double Taxation Avoidance Agreement, then such payment would not be covered because it will become double whammy. It will not be covered, therefore, from the perspective of equalization levy. With respect to what will constitute the online sale of goods or online provision of services, the government has clarified that any one of the following activities, right from acceptance of offer to sale, placing a purchase order, acceptance of the purchase order, payment of consideration, supply of goods, either partly or wholly, any of these activities through the online portal will attract the equalization levy. The amount of consideration chargeable to equalization levy has been clarified, which it includes the consideration for sale of goods, provision of services, and this is a very important amendment to say that regardless of whether the e-com operator owns the goods or service or just facilitated by the e-com operator. And we have to really be mindful that these amendments are applicable from April 1, 2020. Therefore, the companies have already started examining what are all the cases where they could take a view that the supply of goods is covered by the provisions of equalization levy and are not covered by the provisions of equalization levy. In what circumstances can companies take a view that the ERP that they are using is not owned or managed or controlled by them? And what are all the consequences of not paying the equalization levy? Whether any non-compliances by the foreign company, particularly if it is going to be a holding company, will have consequences in the hands of the Indian company. Can the tax authorities try to recover the money from the Indian company, or how can they go after the foreign companies? These are all the points that the companies have already started examining, because the provisions are applicable right from April 1 and the compliance term has already started. Moving on to the next slide. The other important thing which was anticipated in the budget was in terms of the digital tax, which the government wanted to do it through the significant economic presence, which was introduced, the concept was introduced in 2018, which basically said if there are certain activities that happen in India where because of the emerging business models, which is basically the digitized businesses, where the companies, the foreign companies, do not require a physical presence in India. The objective was to also bring a portion of the income which is applicable, or which is sort of identifiable to the Indian operations. This is in line with the recommendations of the BIPS Action Plan 15. It was expected that this applicability would be deferred till such time the BIPS project final outcome comes. However, there has been no specific announcement in the budget which was done yesterday. The applicability has been deferred to April 1, 2021, which is from the coming April. With respect to any overlap between the significant economic presence and therefore what will be the taxes on that and the equalization levy, etc., clarifications are awaited, but this is a new animal, I would call it, as which we have to really be watchful of. The International Financial Services Center has been given a great thrust in terms of government attracting foreign companies to come operate in IFSC through their units. And to that extent, there is good amount of rationalization of exemptions, introduction of exemptions have been provided for. The first one being, if there is a foreign fund, which is an offshore fund basically, and if that relocates to IFSC by way of an unit, then the relocation would be tax neutral right from the offshore fund to the resultant fund, which is an Indian unit, and the shareholders and unit holders of the offshore fund as well. So this is a very welcome move in terms of the foreign companies which can come into IFSC, set up their operations, and the time period for this is being given as 31st of March 2024. Sohail also talked about the aircraft leasing related introduction which has been made. So in terms of a foreign company which gets a royalty from leasing of aircraft to a unit in IFSC, then in such a case, that particular income of royalty for a non-resident is exempted because the amount is received from a unit in IFSC. The only condition being the IFSC unit should have commenced the operations before March 24. The IFSC unit which was getting this aircraft lease, that will be exempted from capital gains tax on transfer of aircraft to a domestic company. Again, condition being that it should have commenced the operations before March 24. This is a very welcome move in terms of the taxation of dividends to the FIIs. Section 196D mandated that the dividends should be withheld at a 20% rate, and it was not giving the beneficial rate of the tax treaty which should be applicable to the FIIs. Now it has been proposed to amend 196D to say that as long as the FIIs have the proper tax residency certificate, etc., then the withholding tax rate would be lower of Indian tax rate or the tax rate as applicable between India and the respective country. Similarly, with respect to the dividend income of the REITs and InvITs, there has been a rationalization. In the last budget, you all would recall that the government has abolished the dividend distribution tax. Thereby, the companies which are distributing the dividends would no longer have to pay dividend distribution tax, and the recipients, by meaning the shareholders, have to pay the taxes on the dividends. So in case of REITs and InvITs, whenever the monies were received by the REITs and InvITs, they had to pay the tax, and then it has to, whenever it is actually distributing the money as dividends to its shareholders, then there was a double whammy which was happening, and therefore this has been now done away with. So to that extent, it is a very welcome move to the REITs and InvITs. And finally, with respect to the tax regime for investment division of offshore banking unit, it has been made on par with the alternate investment fund category 3, whereby the income arising to the foreign company will be on par in terms of the tax regimes and exemptions. And this is also applicable only when the IFSC unit commences its operations before March 24. I would quickly move on to the corporate restructuring changes. These two are quite important in terms of some of the decisions that would have been taken, some of the structures that would have been already implemented by the foreign companies in respect of their subsidiaries in India. The first one is whenever there is an acquisition of another company and the consideration that is being paid for the transaction is more than the value of the assets that were taken, the balance or the excess would represent goodwill. And whether this goodwill is also entitled for tax depreciation or not was the issue in the apex court in case of Smith Securities, and this was delivered at least say 15 years back. Now, a lot of companies, what they started doing was not only on acquisition of a new company which resulted in goodwill, even in case of internal reorganizations within the group, the companies were able to identify a goodwill and they started claiming depreciation on such goodwill. Now, the amendment in the budget prohibits such depreciation on goodwill by straightaway removing the clause relating to depreciation on goodwill. So it basically says goodwill will no longer be eligible for tax depreciation. So if certain goodwill has been recognized already, about say 2 years before, for example, then whatever tax depreciation that has been claimed, that is still fine, subject to the litigations that the companies have to still go through in terms of proving that this goodwill is depreciable. But subsequent to the budget, the depreciation on goodwill will no longer be applicable. Therefore, the companies would have to really look at whatever deferred tax positions that they have taken on this. It has to be revisited, and if there are positions that need to be taken in terms of whether tax provision need to be recognized or in terms of even reworking on the IRR for the completed transactions, and therefore what do we need to do, etc., would be the next step with respect to this issue. The next one is slum sale. Slum sale is basically in case of a particular company, if a division is identified to be moved out to a third party, or it could be a reorganization where a division is made out as a separate company. Instead of doing a demerger where the shares will be allotted in consideration of such demerger, slum sale is essentially when the division is given for a cash consideration without specifying the value for each of the assets and liabilities that move from the main company to the other company. There were cases where the consideration was not discharged by way of cash but by way of shares, etc., and this was also not constituted or it was not covered as part of the demerger definition, and therefore the companies were taking a call that what was to be covered under the capital gains is slum sale, and sale would always mean that there should be a cash consideration. Therefore, if there is no cash consideration, but if it is going to be a consideration other than cash, then such transfer will not be even considered for the purpose of capital gains. In the current budget, they have amended the definition of the transfer in this particular case to say that transfer by any means. Instead of saying transfer by way of slum sale, they have said transfer by way of any means if a division is going out, then such transfer will be attracted under this definition. So this is also a very old ruling in case of Bharat Bijli, which has been reversed now. There are quite a few changes in terms of the tax administration. India had introduced a concept of authority for advance ruling. It is essentially to give a certainty to various foreign companies which are entering into transactions in India with Indian companies. And if there is going to be a question on whether the transaction would give rise to a tax liability or not, and whether there will be a lower withholding tax which will be applicable or not, or in case of a supply of goods from abroad, whether the title is really passing outside India and whether we can take a position that there is no withholding tax that should be applicable on this. For any of these matters, to resolve the conflicts at the time of litigation, the foreign companies were encouraged to go through this authority for advance ruling, and the ruling would always be binding on the taxpayer, which is the foreign company, if it makes the application, and it will also be binding on the tax officer who has got the jurisdiction over this case. The authority for advance ruling was to be charged, it was to be chaired by retired apex court judges or the high court judges, but due to several reasons, the authority for advance ruling was not able to function properly because of the vacancy of the judges, and therefore there has been a significant amendment that has been made where instead of the retired apex court judges or the high court judges, the authority for advance ruling would be named as board of advance ruling, and instead of the senior judges, they would be comprising of senior revenue officials, which will actually sort of have a huge dampness with respect to the functioning of this authority for advance ruling, because it will become more revenue bias as compared to the independent functioning of the authority for advance ruling. All the pending matters before the existing AAR will be transferred to the new board, and the biggest advantage of going to the AAR, which is the binding nature, where the ruling of the AAR would be binding on the taxpayer as well as the tax authority, that provision has been removed. Therefore, effectively, I would say that most of the foreign companies would start thinking on whether this is the right route in terms of getting a certainty, and if they actually lose the arguments in this forum, the next appeal would lie before the High Court. Therefore, all the factual evidences that they could have otherwise shown before the regular appellate authorities, the foreign companies would lose the chance with respect to that. They will have to proceed directly to the High Court only. So to that extent, there is a good amount of I would say debate on the future of this board of advance rulings applicability for the foreign companies. How many people would really go through this particular board? The next one is the discontinuation of the Income Tax Settlement Commission. This is a forum which encouraged companies which had a lot of tax disputes to openly come and show all the records and all that and get into a sort of settlement with the tax authorities. This is again an independent body, very timely, time-bound manner. Within about 18 months from the time of applications, the litigations would be sort of settled. Though it will be only one in a lifetime opportunity for any taxpayer. This particular forum has been discontinued with effect from 1st of February 2021. But all the pending applications which were filed before this authority, it will actually move to an interim board. Finally, on the faceless income tax appellate tribunal, last couple of years the government has been giving lot of thrust on doing the tax assessments, even the first appeals on through video conferences and by filing the necessary papers, etc., through the portals, and clearly avoid the discussions over meetings, etc., to promote transparency, accountability, and all that. Now, this has been also extended to the second appellate authority, which is the appellate tribunal. So, probably in the next few months or a year, we would also get into a case where most of the appeals or the litigations that India would face before the second appellate authority would also become faceless. To that extent, lot of importance need to be given on the kind of submissions that are being prepared by the companies. It cannot be anymore with real court craft only and not with any significant documentation. Therefore, the importance of documentation has to really be noted by the companies whenever they make representations before the authorities. The tax complaints, there has been a reduction of 3 months for any belated tax return that can be filed by the companies or the revised tax returns. Right from processing of tax returns to the selection of tax return for assessment or completion of assessment, etc. In all these cases, as compared to the earlier due date, which has been given under the third column, there has been a reduction of 3 months. And this is again to again the government's intent with the kind of infrastructure and the faceless assessment which is being done. The government feels it is certainly possible to complete the tax assessments much earlier as compared to the current due dates. The last one in this particular slide is a very welcome move in terms of reopening of the completed tax assessments. It used to be a case where in terms of even a completed tax assessment, the tax authorities were having powers to go up to 6 years in case of a regular case, and wherever there are quite a bit of income escaping assessment, then they can go up to 10 years to reopen the old cases. Now, the 6 years has been reduced to 3 years. The tax authorities will not have power to go beyond 3 years now in terms of reopening. And even if there is going to be significant income that escapes the assessments, then the tax authority will have the power to go up to 10 years, but only when he has information that suggests that the income chargeable to tax is much beyond INR 5 million, and it must also get the approval from the highest authority, which is the principal chief commissioner. Therefore, it cannot be the discretion of the tax authority anymore. He has to take approval from the highest authority before he reopens the cases. This is my last slide on the other key tax proposals. Again, this is a very important thing for the US companies which are already into the advanced pricing agreement. The issue is basically, let's take an example where the company has been following a cost plus 10% for the Indian company has been following a cost plus 10% for its provision of services to its US parent. Now it is going for APA in 2017, and the APA is finally concluded in 2021 April. Let's take 2021 April. It is finally concluded at 15%. Now the difference between 10% and 15%, assume it's going to be say $20 million. Now there has also been a provision which was enacted about 3-4 years ago that because of APA, if there is going to be a difference in the money which has been recovered so far by the Indian company and what ought to be recovered, then the difference has to be brought into the Indian books. So in this particular case, the $10 million has to be brought into the books of the Indian company. But when it is bringing that into the books of the Indian company in April 21, so in financial year 21-22, the income actually represents for the last 4 to 5 years. Therefore, ideally, the income should be taxed in each of those years actually and not in 21-22. But according to the alternate minimum tax, that provision was not giving room for this particular income to be taxed in the respective years. Therefore, it was actually creating an anomaly where the tax returns which will be filed subsequent to the APA would take this income for the normal corporate tax return calculations for each of the years, right from 2017 or 18 in our example. However, in case of MAT for 21-22, the entire amount of $10 million was recognized in that year. Therefore, it was creating an anomaly. Now, there is an amendment which has been made to reopen the open years with respect to this and calculate the MAT only with respect to those years and not tax the entire amount in 1 year. There is a new TDS which has been introduced in a different way. There is a tax collection at source which was there. Now it has been moved to tax deducted at source, which is essentially to do with an Indian company which is purchasing goods from another company, other Indian company. In respect of such purchase, there will be a 0.1% withholding tax that will be applicable, and this will also enable the seller in this particular case to claim this money as a tax credit. But this is basically to enable more cash flows to the government on a continuous basis. There has been an expectation with respect to the employee contribution. Whenever the Indian company deducts the contribution from the employees with respect to the provident funds or the superannuation fund, etc. And if there is a delay in payment of that money to the government exchequer, the companies were taking a position that as long as they pay it even in the next year, they should be in a position to get the benefit of the expenditure allowance in the year in which the payment has been made. However, the government was very categorical yesterday when they made this amendment to say that it would not allow the companies to play with the workforce money, and therefore if there is going to be any delay in deposit of the employee contribution of the provident fund or superannuation, and if the amount is not paid within the due date prescribed under the respective law, which is the provident fund law or superannuation law, then it will become a permanent disallowance in the hands of the company. So if there is going to be 100,000 of deduction, which otherwise would have been claimed as an expenditure by the by the company, then this 100,000 will become a permanent disallowance. Finally, in case of dividend income, as I had already said, after the abolition of the dividend distribution tax, the dividend income would be taxed in the hands of the shareholders. Whether the dividend income should also be considered for the purpose of advanced tax computation, because the shareholder would not be in a position to know when it is going to receive the dividend, because it is the action of the company and its board, and therefore the advanced tax liability should be computed after the declaration of the payment of or payment of the dividend. It cannot be anticipated, and to that extent it has been a welcome measure which has been made in the current budget. So I would just pause here in terms of the various proposals that have been given by the finance minister yesterday. Like what Sohail said, there are quite an amount of amendments, and there were at least 70 odd sections out of the 290 sections that got amended, and whatever amendments that we have discussed here are the relevant amendments with respect to the foreign companies that either have operations in India or planning to have operations in India. So with that, I will just end my presentation and look forward for answering your questions. Thank you.
Madan, thank you so much for that presentation. Thank you both to you and Suhail for thank you both you and Suhail for your remarks. All right, there we go on the mute. Thanks, and we really appreciate it, especially both the sectoral analysis and the overall thematic thrust. It sounds like what Suhail's commentary suggests is that the big takeaway is this is moving in the direction of privatization, of the government taking a lesser role in the economy. And Madan, from your presentation, trying to ease doing business by making taxation less of a burden on businesses and less of something they need to worry about over the long term, that they're able to resolve issues of taxation over a shorter time frame going forward. All of which I think are helpful to our members in terms of knowing that going forward, the playing field will be a little more even in terms of competition, and that taxation, the words they have about taxation in terms of administration and compliance will reduce over time, which is, I think, a welcome step. We have several questions in the chat box, one of which comes from Nalima, and I think that we've had some questions on insurance from our members, and this sort of reflects that, as well as the equalization levy over the last day or two, and we have another one from Vivek Abraham at Salesforce over that. So let me just get to the insurance one first. It sounds like there's building opposition in the press to what came out in terms of the announcement about the insurance sector. And Sahel, I think this goes towards what you were saying, that this has traditionally been deemed a sensitive sector. How would you expect this to affect, I guess, two issues, one of which is the safeguards that we should expect in terms of the management and control regulations? And second of all, you laid out what looks like a multi-step process in terms of implementing this, that there needs to be statutory fixes made, there needs to be regulations changed with the insurance regulator, and then it looks like there are also two additional regulatory changes that need to be made when it comes to foreign exchange management rules and related regulations. Our experience with this in the past is that this is an extended timetable that will require continued involvement on the part of industry. And so just love to learn a bit more about you, from you, pardon me, in terms of your views on that.
Thank you, Alex. So yes, this has been historically a sensitive sector, and opposition on these kind of issues is to be expected. But what has changed is that this is a government that is in full control of both the houses of parliament, and through their allies, they control the upper house of the Rajya Sabha, and they have full control at the Lok Sabha level. And the last few years of this government has shown that where they have made an announcement, no matter how sensitive it is, even to the point of strong-arming the legislation through, they go ahead with it. So I would be very surprised to see any sort of a rollback or inordinate delay. Typically, what used to happen in the parliament is that you referred these out to a select committee. And I don't believe that they're going to allow this to happen now, because this is a long pending demand of many, many countries, especially a lot of US companies as well. And I don't think this government is in a mood to roll back these issues. So I'd be hugely surprised if this were rolled back or inordinately delayed.
That's very good news.
Yeah. Sorry, Nalima, go ahead.
No, I just said that that's very good news to hear that there is a clear, at least at the legislative level, that there is not going to be opposition. And like you say, the issues are going to be in the details, specifically of what the provisions with respect to the profit sharing is going to be. Naturally, that's a concern for us. So, no, that's very helpful. Maybe, are there any other, since we're on insurance, are there any other questions from the folks who are on the phone regarding insurance before we move on to Alexander's other questions? If not, thank you. That's very helpful for us.
Thanks, Sahel. Madan, I think this question goes to you, and it's from Vivek Abraham at Salesforce, formerly of Invest India. And he asks, what is the scope of the equalization levy? Does it include intra-company transactions via internal portals?
Unfortunately, yes, at this point in time. This includes even intra-group transactions, as long as it is done through the internal portals. And that is what, as long as the internal portal that we are talking about is either owned or managed or operated by the company which is providing the services, or it is supplying the goods. And that is what has been also clarified in the current budget, to say that as long as the placing of purchase order or the acceptance of purchase order or payment of consideration, if any of these things happen through the online portal, then it will be included in the concept of equalization levy. That's what it says.
Thank you. Very, very helpful. Are there any additional questions? We know that we are a little over time, and we thank everyone for bearing with us. A question. Okay. This comes from Sandeep Samadar. The new section 206AB, whereas a special provision providing for a higher rate of TDS for the non-filers of income tax returns. However, the compliance burden of the TDS seems to be on the deductee. Is this accurate?
Yeah, that's right. And this is a provision again. Basically, the government feels that most of the people have got the PAN, etc. But this is still to enforce the compliance with respect to people who don't file the income tax return. Therefore, there is I would say a penal provision for a higher rate of TDS, which is about 5% higher. Yeah.
Okay. Thanks so much. Okay, so we're at about 10 minutes over time, so I think we're going to stop here. I'd just like to thank everyone for joining. I'd also like to note that both Suhail and Madan have made clear that if folks have supplementary questions or would like to talk further with them, they're open to that. You can just contact Nilima and me, and we can put you in touch with Suhail or Madan. We can also share their presentations with you if this would be helpful. We're always happy to make that connection. I'd also like to mention that our Budget Week programming concludes on Thursday, February 4th, with what we're deeming a sort of look forward on the budget, which is really going to be a higher level discussion about where do we see India going after the budget in terms of economic growth and expansion. We'll have a keynote address from Arvind Ramani, who is a former chief economic advisor, and a high-level panel of managing directors and CEOs from Indian companies and companies active in the U.S. India corridor. It's open to everybody, so if you'd like, if you haven't already gotten an invitation, please let Nilima or me know, and we'd be happy to share it with you. Madan, Suhail, thank you so much for your time today. Nilima, Devika, everyone at USIBC, thanks so much for your support in making this happen. And everyone who has joined today, thanks so much. Good night.
Thanks a lot, Alex and Nilima, for the opportunity.
Thank you.
Thank you. Very helpful. Thank you, everyone. Bye-bye.